Japan's bond market didn't crack. It went nuclear. Traders watched the 30-year yield rip past 3.3%, a level no official in Tokyo has ever confronted, and the dealing rooms froze as if someone severed the financial oxygen line. The yen buckled, liquidity vanished, and across trading floors from Singapore to London, algorithms started flagging the same nightmare scenario. Japan's debt engine had seized so violently that the only pool of capital large enough to save it sat inside Washington's vaults. A senior strategist told Reuters that the math left no domestic solution, and that's when the Treasury's global markets team understood what had just been triggered. Not a rumor, not a threat. The opening stage of the first forced liquidation of U.S. bonds by America's most trusted ally. A move powerful enough to send a shockwave straight into the heart of the United States economy. Fewer dollars earned abroad magnify the risk of a yen shock at home. Tourism, the fallback that often cushions lost trade, was already buckling. The Financial Times reported earlier this month that political tensions led Beijing to retaliate through aviation, and Japanese airports saw the effect immediately. The October arrivals data counted more than 10 million visitors when including Hong Kong, quadruple the volume arriving from the United States, yet China had already instructed its major airlines to cut flights to Japan until March. 12 routes from key cities including Shanghai disappeared entirely, and December flight schedules show a 20% reduction compared to last year. Tourism accounts for 8% of Japan's GDP, and the region supplying most of that traffic just turned off the taps. By mid-month, the domestic consumer was showing signs of strain as well. Japan's Statistics Bureau reported consumer prices rising about 3%, matching the United States, with core inflation at 3.1% even after stripping out energy. Wages increased by less than 2%, which means households are losing real purchasing power. Bloomberg's inflation desk noted that rising insurance costs and goods inflation continue to outpace income growth, leaving Japan unable to count on domestic consumption to offset external collapse. A country cannot escape this kind of squeeze without raising interest rates, but the Bank of Japan stands at a cliff's edge. Government debt sits above 230% of GDP, and a rate hike threatens to detonate the fiscal framework. The BOJ continues purchasing roughly 3 trillion yen in government bonds monthly, a figure highlighted in recent reporting by the Wall Street Journal, and that buying, equivalent to around $20 billion, functions as yield suppression through artificially induced demand. Most of the purchases target 1 to 10-year maturities, with heavier focus on the longer end, because the BOJ understands that rising long rates would immediately raise the country's debt service burden. Every bond the BOJ absorbs with printed yen weakens the currency and deepens the future crisis. Investors are reacting accordingly. Bloomberg's foreign exchange tracker shows the yen falling nearly 8% against the dollar over 6 months. Under normal conditions, rising yields should attract inflows and strengthen the yen, but capital is moving the other direction. Trading desks are shorting the currency on the assumption that Japan will continue printing, and the cost of imports, from LNG to industrial steel, is rising as a direct result. This is the kind of downward spiral that becomes self-reinforcing. Policymakers realize they are watching confidence slip out of their hands faster than policy tools can react. Then came the news that cemented the fear. Reuters broke the story that Tokyo approved a 21 trillion yen stimulus package, more than $130 billion, designed to ease inflation pressure and protect strategic industries. The size equals roughly 3.5% of the nation's GDP, and nearly 12 trillion yen of it is unfunded. Japan will issue $73 billion worth of new bonds to cover the gap, even as existing bond markets reject long-term exposure. The government needs investors to trust in the future of Japanese debt at the exact moment trust is evaporating. Bond markets delivered their verdict instantly. Japan's 30-year yield surged past 3.3% for the first time in the country's history. The Financial Times highlighted the shift as a structural rejection of ultra-long exposure, noting that buyers are refusing to take positions where the currency could outweigh any coupon return. The flagship 10-year climbed above 1.8%, the highest since 2008, and volume across longer maturities thinned sharply. Rising yields signal a confidence collapse, but suppressing those yields through printing accelerates the collapse of the currency. Foreign funds that once supported JGB demand have turned into net sellers. That change matters because Japan relies on stable external demand to maintain market functioning. With exporters suffering, tourism falling, wages stagnating, and inflation entrenched, Tokyo is losing every stabilizer at once. The country is being pulled toward a liquidity requirement that its domestic market cannot supply. Bloomberg economists pointed out that Japan's remaining shock absorber is its foreign reserve portfolio, dominated by U.S. Treasuries. The Treasury Department's latest data shows Japan holding roughly $1.2 trillion in U.S. government debt, having added $110 billion between January and September. Japan stands as the single largest foreign holder of U.S. Treasuries at a time when BRICS nations have been net sellers. That stockpile, accumulated over decades, now represents the only scalable source of liquidity Japan can mobilize without immediately collapsing the yen. And this is where the fuse lights. Treasury Secretary Scott Bessent, during his visit to Tokyo earlier this year, covered by Bloomberg, offered polite encouragement for policy normalization, but the context behind his words was unmistakably defensive. He emphasized that U.S. bonds had become the best performing in the developed world and highlighted the fiscal improvement generated by tariffs and revenue flows. Yet the subtext aligned with the administration's broader strategy. A stronger yen relieves pressure on the dollar and supports the president's preference for a weaker reserve currency. For that to happen, Japan would need to raise rates and unwind stimulus. But Japan cannot raise rates without risking a fiscal accident. This sets up the contradiction driving the entire crisis. Washington wants a stronger yen while Tokyo risks collapse if it stops printing. The consequence is clear. If Japan cannot normalize policy domestically, it must search externally for liquidity. Selling U.S. Treasuries becomes the only move that does not immediately push the yen into a deeper crash. It is not ideological. It is mechanical. Japan needs currency support, stimulus funding, and market stability all at once. Selling Treasuries provides liquidity without expanding the yen base. The impact on the United States would be immediate. Treasury markets are already strained. Washington began the new fiscal year with a $284.4 billion deficit in October, the largest opening month deficit in U.S. history, according to Treasury data reviewed by the Wall Street Journal. Government spending rose 18% year over year to nearly $689 billion, and Bessent has been issuing large amounts of short-term debt to keep borrowing costs contained. Goldman Sachs analysts told the Financial Times that maintaining the appearance of strong demand has become central to U.S. debt strategy. A Japanese liquidation, no matter how orderly, would break that appearance instantly. A surge in Treasury supply colliding with rising U.S. deficits forces yields higher across the curve. Japan's holdings are heavily weighted toward longer maturities. The Congressional Research Service previously reported that foreign official institutions prefer durations of roughly 8 years or more. That means a sell-off would land hardest on the 10-year yield, the benchmark that determines mortgage rates, corporate borrowing costs, local government financing, and the baseline cost of credit throughout the U.S. economy. A spike in that rate would ripple through housing, business investment, municipal budgets, and financial markets simultaneously. The Federal Reserve cannot intervene without reintroducing inflation pressures at home. And the U.S. cannot reduce borrowing. It needs more. The United States is operating in a fiscal environment where every Treasury auction is larger than the last, and deficits are rising even as tariff income reaches record levels. If Japan sells, the strain becomes visible immediately, and the political consequences would unfold faster than the economic ones. Policymakers realizing that the ally they trust most holds the lever that could destabilize their entire bond market. Japan understands the stakes. It also understands that the alternative, continuing to print yen to suppress yields, will send the currency deeper into a downward spiral. Every point of yen weakness raises import costs, pushing inflation upward and increasing pressure on the BOJ to intervene again. This loop cannot hold indefinitely. The only release valve with enough scale is the liquidation of foreign reserve assets. And those reserves are overwhelmingly U.S. Treasuries. The unanswered question is not whether Japan wants to sell. The question is how long Japan can avoid selling before external pressure forces the decision. Bond markets move on expectation, not action. The first sign of a shift will appear in auction coverage ratios, foreign bid allotments, and long-end yield volatility. Those indicators will reflect stress long before Tokyo announces any strategic decision. And once the selling begins, even in small amounts, algorithms and portfolio managers will mark the risk into every long-duration asset they hold. Japan stands on a narrowing ledge. Tokyo needs liquidity to fund its stimulus, stabilize its bond market, and shield households from continued inflation. Each of those pressures grows heavier each month. Selling treasuries gives the government breathing room without adding yen supply. For Japan, that option becomes more attractive the weaker the yen becomes. For the United States, it becomes more dangerous the larger the deficit grows. The fuse is already lit. The only unknown is how quickly the flame reaches the powder. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.